Today on the program, World Bank says poorest countries to save $12 billion in 2020 debt relief. The BRICS New Development Bank provides South Africa with $1 billion COVID-19 loan. And S&P Global affirms African Development Bank's AAA rating with stable outlook. Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwago. First to the markets, and the Nigerian market showed a positive start to the week at intraday, though trading marginally up. The JSE index was also in the green zone, up 0.16%. Egypt, on the other hand, was down 0.56%, while Kenya closed the week on Friday negative. And in the Middle East, mixed sentiment was observed at intraday, with the markets in the UAE up while others were down. The Dubai stock market rose after the Emirates said it would allow tourists to enter from July 7 in a further easing of its coronavirus lockdown, outperforming other major Gulf markets which retreated in early trade. Now the index rose 0.5%, with its largest lender Emirates MBD rising 1.2% and budget airliner Air Arabia gaining 1.8%. The Abu Dhabi index was up 0.28%. Saudi Arabia's benchmark index eased 0.66%, with petrochemical firm Saudi Basic Industries down 0.4% and ROG Bank 0.2% lower. Qatar's index was down 0.26%, with most individual stocks in the red. Qatar International Islamic Bank slid 2.7%, and Qatar National Bank, the Gulf's largest lender, dropped 0.6%. In Europe, stocks retreated this morning as investors react to a surge in coronavirus cases in the States and growing concerns over a rise in infections in Germany. Let's bring in Chelsea Dulani now for details. Hello, Chelsea. Good afternoon. Good to see you. Well, European stocks started the week under pressure amid rising fears of a second wave of coronavirus infections. How real are those concerns at this point?
They are becoming increasingly real, and we are seeing that reflected in markets now. Public health officials, investors, economists, everyone has been warning for months that that we would likely see a second wave, especially as these lockdown restrictions have been rolled back here in Germany, throughout Europe and the United States as well. People have sort of kept it in the top of their mind that as these restrictions are eased, the likelihood of infections rising is quite high. We are seeing that happen now here in Germany. As you mentioned earlier, the number of coronavirus cases has spiked, so-called reproduction factor. So the number of cases that stem from one infected person has risen to 3 almost from about 1 earlier. So this is a very worrying sign. So far, these infection outbreaks have been really localized. So we've seen a huge outbreak near a slaughterhouse, and also in a single apartment building in Berlin. There have been a lot of people quarantined, but as these infections grow, that obviously poses a big threat to this recovery that we've seen in global markets. The fear now, of course, is that these restrictions are going to have to be put back into place, that we'll see businesses close again, that we'll see factories shut down, supply chains shut downs again, like we saw earlier this year. And we already have seen that a little bit in the United States, where there are a lot of hot spots. So on Friday, Apple said it was going to close 11 of its stores because of these surges in cases. And so there definitely is a concern that the recovery we've seen in markets, the recovery we've seen in economic data is not going to last much longer if cases continue to rise.
It's being called one of the biggest corporate accounting scandals in Germany's post-war history. German financial tech firm Wirecard now says the 1.9 billion euros reported missing from its accounts last week likely doesn't exist. How can that happen?
Well, Wirecard is it's been really hailed in Germany as the future of German finance. It's been this really big success story for Germany. but it has been dogged by these accusations for years, for several months and years now, that it is inflating its profits and revenues. So there have been several investigations, several media reports showing that the company's subsidiaries, the company's clients, just don't seem to exist. So this all does connect to this 2 billion euros that the company now says may have never existed. This 2 billion was supposed to be sort of the cash generated by these subsidiaries. They aren't really sharing what they think happened to it, but they say they could have been subject to some sort of third-party fraud, things like that. But this is definitely going to create a lot of problems for the company going forward, both from a regulatory and a financial standpoint.
All right, thank you very much, Chelsea, for your time there. The week has just started, so let's just see how events unfold. An anxiety, of course, over a possible second wave of COVID-19 infections is knocking investors' confidence, undermining hopes of a bounce back in growth as economies reopen. Let's see how that is also playing out in the UK this intraday. Juliana joins us now. Hello, Juliana. Good afternoon. So how are the markets holding up this intraday with the news of second wave of COVID-19 infections?
Good afternoon, Chimmy. It's pretty sluggish. It started in the red at intraday in early trading, and at intraday it's still in the red here. The all-share is down 0.08%. The FTSE 100 is down 0.13%. And the FTSE 250, that domestic market, is down 0.15%. In currencies, the pound is up on the US dollar by 0.26%, down on the euro by 0.07%, and up against the Japanese yen by 0.26%. We are expecting Prime Minister Boris Johnson to outline whether or not he'll be scrapping that 2-metre distance rule here in the UK. So at the moment, you can't be within 2 metres of people, as impossible as that may seem. But we are waiting on details of the hospitality sector. They're really desperate to open. We think that will be the 4th of July, but it cannot work unless it's scrapped. But now we are hearing about this second wave, particularly as it is happening in Germany. And we've also just heard a couple of hours ago that a food processing plant in North Wales has had 186 suspected cases of the coronavirus. So there's a big topple that Prime Minister Boris Johnson must get his head around. And of course, there are always going to be winners. It's worth mentioning that at the moment, the supermarkets are doing pretty well on the FTSE 100. Sainsbury's, Tesco, Morrison's and Ocado all up between 1% and 5%. And that's because they're hoping, the rumours are true, that the Chancellor will be slashing value-added tax, which will be very, very good for their shoppers.
All right, and then even the Bank of England, Governor Andrew Bailey has revealed that the central bank is changing its strategy on unwinding its stimulus measures. Is this also making rounds on the market streets?
It isn't really, because, of course, I think most traders would expect that this stimulus package, which I believe stands at about £745 billion, cannot last forever and is only for an emergency. Last week, the Bank of England Monetary Policy Committee added an extra £100 billion. So they'll be adding that over the next couple of months. And he did give an exclusive interview to Bloomberg where he did say that, this cannot go on forever. Some of the other quotes that I pulled out, he said the current scale of central bank reserves mustn't become a permanent feature, that elevated balance sheets could limit the room for manoeuvre in future emergencies, and that the response has included a major programme of asset purchases and lending by central banks with a corresponding growth of balance sheets. Already we know that Andrew Bailey, who's only been in the position since March, has really come in at an unprecedented time. Just before the pandemic hit the shores, he was already, having to get some tips and tricks from Mark Carney, because, of course, we had Brexit to deal with, which was a huge shock to the economy. But at the moment, interest rates stand at 0.1%, which are an unprecedented low, a historic low for the Bank of England. And he doesn't want them to go any lower. And he has, as I just quoted, been pointed out that this stimulus package that the Bank of England is overseeing at the moment is unprecedented and cannot continue at this rate if Britain is going to have a successful recovery.
And on data, the CBI reports that British industrial output shrank at an unprecedented pace in the 3 months to June as COVID-19 heavily disrupted operations. What are the details of this data? What subsectors were mostly hit?
Well, the subsectors that the CBI have pointed out are motor vehicles, transport, mechanical engineering, and medical, metal products, among others. I believe there are about 15 of the 17 subsectors that are in increased decline. And we really know this. The CBI, they talk to about 360 manufacturers across Britain, taking their data from them. And as you said, it's the output is at a real historic low, although there has been a little bit of an uptick since May. But the exports is what's really worrying the industry. I believe the CBI has been taking this data since 1975. And what they recorded as exports in June was the worst that they've seen in their recorded history, which is pretty bad. Did it hit the FTSE? Just a little bit. I believe as soon as this came out, it went to lower by a couple of points. But some economists are a little bit hopeful because they say even though we are going to see this decline over the next couple of months, we believe that in the next quarter, the decline won't be as rapid as it is. So it'll be interesting to see what the manufacturing PMI tells us that June has been like when it's released sometime tomorrow, Chimay.
All right, we'll keep an eye on that. Thank you very much, Juliana. Enjoy the rest of the day. And stocks in Asia traded mixed today as the number of coronavirus cases stateside soared again. In Japan, the Nikkei 225 closed 0.18% lower, while the Topix index ended its trading day at 0.23% lower. South Korea's Kospi closed 0.68% lower. Hong Kong's Hang Seng index dipped 0.75% as of their final hour of trading. Mainland Chinese stocks were mixed on the day. The Shanghai Composite dipped slightly to about 2,965.27, while the Shenzhen Component added 0.294% to around 11,702.44. Over in Australia, the S&P ASX 200 closed above the flat line at 5,944.50. Overall, the MSCI Asia ex-Japan index slid 0.18%. And U.S. stock futures were little changed, pressured by persistent worries about the coronavirus outbreak. Dow Jones Industrial Average Futures implied an opening gain of about 50 points. S&P 500 and Nasdaq 100 futures were also nearly flat prior to the opening bell. The major U.S. stock averages are coming off their fourth weekly gains in 5 weeks. Both the Dow and S&P 500 advanced at least 1% last week, while the Nasdaq Composite surged more than 3%. News of the Federal Reserve buying corporate bonds, along with a record spike in U.S. retail sales, lifted sentiment on Wall Street last week. Expectations of an economic recovery also buoyed stock prices. However, the number of newly confirmed coronavirus cases across the U.S. and elsewhere in the world continues to increase, raising questions about the global economic recovery. And global oil market prices nudged higher in the morning on tighter supplies from major producers, but concerns that the record rise in global coronavirus cases could curb a recovery in fuel demand checked gains. Brent crude rose 9 cents to $42.28 a barrel, while U.S. crude was $39.76 a barrel, up 1 cent. Both contracts rose about 9% last week, and Brent crude futures flipped into backwardation, where oil for immediate delivery costs more than supply later, usually an indication of tightening supply. In the United States and Canada, the number of operating oil and natural gas rigs fell to a record low, even as higher oil prices prompt some producers to start drilling again. However, the OPEC Plus group, consisting of Organization of the Petroleum Exporting Countries and its allies, including Russia, has yet to decide whether to extend a record supply cut of 9.7 million barrels per day for a fourth month in August. And in metals, gold jumped to its highest in more than a month in early trade today as investors sought the safe haven metal after surging coronavirus cases intensified concerns over a delay in global economic recovery. Spot gold was up 0.7% to $1,754 per ounce after hitting its highest since May 18. U.S. gold futures rose 1.1% to $1,707 to The World Health Organization reported a record increase in global coronavirus cases on Sunday, with the total rising by 183,020 in a 24-hour period. In other metals, silver climbed 1.7% to $17.91 per ounce, to its highest in more than a week. Palladium gained 0.2% to $1,914, while platinum jumped 1.6% to $818.18. And still to come on the program, S&P affirms Africa Development Bank's AAA rating with a stable outlook. These and more in a moment. Ratings agency S&P has affirmed its AAA long and short-term issuer credit assessment of the African Development Bank with a stable outlook. The rating agency positively assessed the bank's very strong financial risk profile, very strong capital adequacy, strong funding and liquidity, extraordinary shareholder support, and adequacy of its governance and management. The rating agency noted the bank's $115 billion capital increase approved by shareholders in October 2019 and the replenishment of the African Development Fund, the bank's concessional window in December 2019. The stable outlook, according to the agency, reflects its expectation that over the next 2 years, AFDB will prudently manage its capital while maintaining solid levels of high-quality liquidity assets and robust funding. S&P expects that shareholders will remain supportive by providing timely capital payments. The bank will continue benefiting from preferred creditor treatment and prudently manage growth in private sector lending in a way that's aligned with its mandate. The rating agency's report further noted that the AFDB will play a key role supporting the region, particularly in the context of COVID-19. And since the beginning of the COVID-19 pandemic, African debt relief has returned with a vengeance to the top of policymakers' agendas. As the devastating impact of the pandemic destroys growth, African governments are desperate to renegotiate and extend billions of dollars of loans signed in more auspicious time. In all of these, analysts say the role played by China, Africa's largest bilateral creditor, will be critical. All right, let's talk more about this with a senior analyst for Sub-Saharan Africa at Docker Frontier, Matt Koeniger. Good afternoon, Matt. Thank you for joining us.
Good afternoon. Thank you for having me on the show.
So China has become heavily commercially involved in Sub-Saharan Africa in recent years. Which countries have become the most dependent on Chinese loans?
Yes, so China has become increasingly heavily involved in Sub-Saharan Africa, especially. This is no surprise. There's been a lot of coverage of this over the last couple of decades. And by some estimates, China has extended up to $150 billion worth of loans to Africa in the last 20 years. These funds have mainly been channeled into large infrastructure projects, and these are increasingly linked to China's Belt and Road Initiative. Nonetheless, there are significant differences between countries in terms of their exposure to China, in terms of Chinese loans. Djibouti is an extreme example where nearly it has loans outstanding to China worth nearly 100% of its GDP. Most other African countries have a much lower exposure. Nonetheless, there are several countries such as the Republic of Congo, Niger, Zambia, Ethiopia, and Angola that have between 10 and 30% of their GDP outstanding in Chinese loans. So there are a number of countries that are quite exposed.
Now, how will a decision by China to write off some debts affect the ability of African governments to service their debts?
Yeah, so in our view here at Docker Frontier, this won't, the latest development that the Chinese government is looking to write off some of that to Africa won't have a significant impact on the health of government finances overall in Africa. It may provide some short-term relief, but it won't materially affect the fiscal positions of most African governments. And this is for two reasons. One is that the Chinese government has opted to only sort of restructure or write off a small proportion, about 5 to 10% of its total lending to Africa. And the other is that although China is the single largest lender to Africa, it only accounts for 20 to 30% of total outstanding debt in Africa. So up to 70% of Africa's debt still needs to be repaid, and a large portion of that debt is held by private international bondholders, and they are much more difficult to renegotiate with.
And what do these recent developments mean for the future of China's commercial relationship with Africa?
Yeah, so it's a very good question, and this is China's relationship with sub-Saharan Africa, Africa overall, has increasingly come under the spotlight. There's been some political resistance within Africa as a result of the COVID-19 pandemic to Africa's relationship with China, and there are some moves by some markets across the region to pivot slightly back towards, say, Europe and North America for financing and investment. So there will be a sort of period of soul searching in our view. However, we don't expect the country's or China's commercial relationship with Africa to change fundamentally. And this is because Africa remains strategically very important for China, both geopolitically and also in terms of the resources that Africa has to offer to China. And additionally, Africa's largest trading partner is China. It's very dependent on China for exports. So most African governments won't want to alienate China. So, and also another factor is that many African governments will struggle to get finance from other sources over the coming years, and so they will still remain fairly dependent on China for finance as well. So for the foreseeable future, we do expect Chinese companies and Chinese financing to play a significant role in Africa for the foreseeable future.
All right, thank you very much for your time, Matt. Matt Koeniger is the Senior Analyst for Sub-Saharan Africa at Docker Frontier, London. And the World Bank says the world's poorest countries could save over $12 billion owed to sovereign and other creditors this year through their participation in a debt relief program, with Angola alone saving some $3.4 billion. The savings under the COVID-19-linked debt service suspension initiative, DSSI, will be short-term since the initiative only provides for suspension of debt payments through the end of the year. It postpones those payments until a later date but does not cancel them outright. World Bank data shows the second largest saver among eligible DSSI countries will be Pakistan, with $2.4 billion, followed by Kenya with $802 million. In terms of savings compared with gross domestic product, Bhutan would reap the most benefits from the plan with 7.3% of GDP savings, followed by Angola at 3.7% and Djibouti at 2.5%. The DSSI is backed by the G20, the World Bank, the IMF, and the Paris Club of Sovereign Lenders. And the new development bank established by the BRICS group of emerging nations has approved a $1 billion COVID-19 emergency loans to South Africa to help reduce the social economic impacts of the pandemic. South Africa was already in recession before the pandemic wreaked further havoc in Africa's most industrialized economy. Finance Minister Tito Mboweni is expected to unveil an emergency budget with major changes to spending and revenue forecast in Parliament on Wednesday. The government last week further relaxed 2 weeks of tough restrictions as it looks to support the economy. Brazil, Russia, India, China, and South Africa are members of the new development bank. And with that, we wrap up today's program. Thank you for watching. I'm Chimeze Obi Uwago.